with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, August 7th, 2026. We are in the dog days of summer. Some shout outs to Wayne, Rick, Diane, Scott, and Bob. Thanks everybody for tuning in week week out. We do appreciate it. That's why we do what we do. So what about this market this week? Well, the market did something big this week, and there's a phrase for it in our industry. It's not a very nice phrase. Go figure, right? Our industry is just full of crazy phrases. But the market had a rip your face off rally this week. That's what we call it, folks. A rip your face off rally, just up like a rocket ship. Let's go ahead and jump into it. Dow Jones Industrial Average up 2.9% on the week. The S&P 500 up 3.5%. The NASDAQ Composite up 5.1% this week. And the Russell Small Cap Index up 3.5% this week. We saw some record highs in the Dow Jones, the S&P 500. So big moves higher for the week. We'll talk about some of the whys here in a moment. The volatility index, as you might expect, with all this big move higher, the volatility index drifted lower this week because everybody was joining the party. There was no fear to be found. So the VIX was down 6.8%, finished at a 14.9. Even long-term bonds got in on the action. They were even up a little bit this week. They were up 0.6% on the week, still negative on the year, negative 5% on the year, but they were up a little bit this week. And again, we'll talk about why in a moment. Gold and silver. Gold up 7.25%, silver up 9.8%. Some big moves higher in gold and silver. And I got to tell you, I'm disappointed by that. I'm really disappointed by that. I was ready to make my move on gold this week. I was ready to make the move. I've been doing a deep dive because, look, when we like to get in the gold trade, we like to use gold miners. Long-term clients, you know, we got a gold miner back in 2022, and we kept it all the way until the fall of last year and did incredibly well with it. It was Kinross Gold and went from like $5 up to 24 and change. And we sold it. We got out of it. We got out of it because gold looked stretched. It really looked overvalued, and I just thought that it was poised for some sort of correction. Well, we've gotten that this year. We've gotten a big correction this year in gold from those highs, and it looks like it's maybe finally found a floor, and it looked like it was starting to look more constructive. So I've been doing a deep dive on gold miners, not necessarily interested in going back to getting the one we had before. I'm looking at some different ones, so did a real deep dive on it, and I was ready to pull the trigger. I almost did it on Tuesday, but I just wanted to do one more quadruple check on my numbers and make sure I was buying the one that I really wanted to buy. So I worked on it late Tuesday night, ready to buy it on Wednesday morning, and the daggone stock opened up 6% and it ended up finishing the week from Tuesday to today up 20% this week, and I missed it. And that makes me mad. I have to tell you, I just angry about that. But, the market has a way of going up and down, and there's a couple of gaps there. So I think it'll probably pull back in here at some point in time in the next few weeks. And when we get the opportunity, we'll jump in there and buy it. I don't like to chase things that are moving like that. So we'll wait for a little bit of a breather, and we will step in. I do know what we're going to buy. I can't talk about it yet, but I'll talk about it after we make the purchase. But yeah, gold and silver up a lot this week, and gold beating up yours truly a little bit. Thank you very much for that. How about the rest of the sectors? What we saw this week were the defensive areas did very poorly. I mean, utilities were down 1.6. Real estate was down 0.2. Energy down 3.4. You can chalk some of that up also to a lot of jawboning about something happening with Iran, something positive. which is really still yet to be seen. This has been a story that's played itself repeatedly over and over again. We'll see how it shakes out this time. And then consumer staples, which are also very defensive, completely flat on the week. They did nothing. So all the defensive areas really doing poorly and everything else just doing great. I mean, up and up a lot. Industrial's up 2.9%. Who thought Caterpillar, the big yellow tractor company, would be an artificial intelligence play, an AI trade? Caterpillar. Yeah, I mean, they are, because they are involved in building all these data centers. Look, these big hyperscalers, Google, Amazon, Facebook, et cetera, they're spending over $1 trillion to build out the computer capacity that they need to execute on these AI products. And it's bleeding into all areas of the economy, including Caterpillar, bulldozers, believe it or not. So look, industrials are up 2.9% and materials up 4.8%. Discretionary up 3.25%, and then tech up 7.2% this week. So a couple of things about that, about the technology space. A lot of pressure was put on tech stocks with that hedge fund blowing up a couple of weeks ago. We talked about it, that situational awareness that the guy no longer has any, never did, I don't think, the way he was managing that money. 4 times leverage, that's just insane, 400%. Anyway, it blew up, and when it was blowing up, it put a lot of pressure on the tech sector because that's what it was all invested in. And some folks are saying, hey, this is the rebound from that. It got beaten up badly. Now it's rebounding pretty violently. We'll see how that shakes out longer term. I think that could definitely have something to do with it. There's a lot of shorting that was going on. And we get these things called short squeezes where they've got to get out of those trades and cover their shorts. So when they do that, they got to buy the stock. So there's a lot of forced purchasing happening as well. So a lot of things going on there. And I do think a lot of it is probably related to that hedge fund blow up and the subsequent recovery. We've also got some economic data that's making a difference. Look, we had a terrible jobs number today. Negative 23,000 jobs. Look, the market was looking for a positive 83,000, looking for 83,000 jobs gained, and instead it got 23,000 jobs lost. I was wondering about how this number was going to play out because I was kind of curious to know if all of the extra employees from the World Cup, all the folks that were employed to do World Cup jobs, if they were going to show up in the numbers for this month. And maybe that's some of that. There's some commentary today that said it could be some of that. But bottom line is that weak jobs number is good news for the market. Look, I know that is really just like backwards. I get it. The market sometimes, and we're in that position right now where it is looking at bad news and seeing it as good news. And the reason why is that the market now doesn't think that the Fed is going to raise rates in September. The market's been pretty hot on the Fed raising rates in September because inflation's continuing to be extremely sticky. I'm not sure Warsh wants to do that. I think that he sees supply shocks driving a lot of this inflation. I think he's hoping the market, interest rates being driven by the bond market, can kind of correct some of the frothiness and spending and calm things down a little bit without actually having to touch the Fed funds rate. But the market's been pricing it in, and those odds of raising rates in September dropped from 58% to 42% when that payroll number came out this morning. So that's having an impact and also have an impact on bonds. That's why you saw yields go down a little bit, also have an impact on gold, right? When the dollar is going to weaken, when rates are going to stay low or go lower, gold is going to perform better. So all of those things were kind of related this week. And other than that, I've got to tell you, the economic data has been okay. It's been mixed, but it's really been earnings driving everything. Earnings have just been incredible. We talked about Caterpillar just a moment ago, for example. Palantir, another AI company, had a monster quarter. We're seeing some big quarters from some big companies. We don't have those particular ones in our models, but bottom line is they've been having some monster quarters, and it's driving the market higher. I will say this, though. The market's starting to respond to changes in delta. We've talked about delta before. That is the rate of change, So you can be going up and up and up in earnings. But if you're not going up as much as you were last quarter, the market will start to respond to that. And we've had a couple earnings reports where the delta's changed. They beat, but they didn't beat by as much. They raised their guidance, but they didn't raise by as much. And the market has some pretty negative reactions to a couple of those reports. But overall, earnings have been incredible. The question is, are they sustainable and for how long? When you have the hyperscalers spending well over $1 trillion, that is a lot of money pouring into the economy. But you have to question its sustainability. It doesn't matter to me how long it runs. We'll make money on it. We're invested very heavily into the market. We're going to do just fine. But it does say to me that you won't see it coming until it happens. And therefore, you want to keep the hedges in place and be disciplined with that. Now, we might get a little more constructive on this market coming into the midterm elections because there is a historical analog from the midterm election to June 30th of the following year, 21 for 21 times since 1942. It's been a positive period. 21 out of 21, 100% track record in the modern era of the S&P 500. And if you go all the way back to the 1800s, it's 30 out of 38. It had 8 misses prior to World War II, but the markets were a little wonkier back then. There's a couple of different things to factor in there. But bottom line is it's been a strong seasonal period, one of the strongest there is for the market. You can almost take it to the bank. And things are looking right now where that could hold up again. Not that there's not some volatility in there, but it could hold up again. So if we get an opportunity, I thought we were going to get one. I mean, look, I thought the market might be heading down to 7,000 until it just turned on a dime and went straight up. That's okay. But if we get one heading into the midterm election, which is highly probable, look, this is a terrible season. This is a terrible time of year for the market, especially in midterm election years. August, September, October tend to be very volatile and pretty ugly. So if we get that opportunity, we might get a little bit more constructive on the market, a little bit more. And of course, there's that gold company I like to buy too, if the opportunity arises. For all you new folks, we've already got your money worked in. We've been working in very aggressively over the last couple of weeks while the market was down. There's only a couple more things we want to buy for you, not much. We've pretty much got everything in place except for a couple of holdings. And as soon as we get a little bit of a step back on those, we'll get those worked in for you also. But bottom line is this, the market itself, this rip your face off rally is a little bit of a reason to be concerned. And the reason why I say that, it's only happened 3 other times in history where the market has risen this much, 5% in a week, and hit all-time highs at the same time. It's only happened 3 times. And of those 3 times, one was 1999, April of 1999, one was March of 2000, and one was November of 2020. Now, the first 2 doesn't look so good. Market was down 4% after a month, flat at 3 months, and down 3 to 5% at 6 months. At 12 months, one case was down 25%, the other one was up 5%. So a little bit of a discrepancy there. The other analog, November 2020, it was up at the 1 month, 3 month, 6 month, it was up 32% 12 months later. Now, here's the thing about 2020. If you recall, we were coming out of a shutdown economy, right? That was coming out of the COVID shutdown, and things were starting to open back up again. So we had a violent move to the upside when people started realizing that the world wasn't coming to an end. But the other 2 analogs don't look so hot. And I'll tell you something else. The other 2 analogs look a lot more like the market we're in today. 1999 and 2000. That's when we had the big tech move higher, when they had the tech bubble and stocks were pushing up so much, so fast. So these are just like little things that I watch, I keep my eyes on. You add a couple other things to it, there's always reason to have some concern. And I'll just say this to you. This is not the point in the business cycle to swing for the fences. It's not. A lot of money was made from 2022 till now. And now's the time to be very disciplined, extremely diversified, not trying to swing for the home runs and the grand slams. This is not the time to do that in the business cycle because recessions don't announce their arrivals. Bear markets don't usually give you warning. The stuff just happens, right? And I'm not saying it's going to happen anytime soon, but when it does, oh my gosh, you won't be prepared for it unless you're prepared. Now's the time just to stay disciplined. It is. And if we make a little less money, I'm okay with that. That's not the case right now. The market did catch up to us this week, but it's still got a little more work to do to get past us. All that said, we're not trying to beat the market. We're trying to stay disciplined and diversified. When the time comes, the market rolls over and there's a real big move to the downside, that's when we get excited. Okay, that's when we really want to jump on the market and start buying aggressively. Now's not the time to do that. The market rips higher, we'll make plenty of money. We got plenty of exposure. But as we've already seen throughout the course of this year, if it wants to go through little tantrums and have some issues, we've got the hedges in place to help us out. And I think that's important right now. That's what we're really focused on. So look, that's what I've got for you this week. Everything's just chugging along. It's sunshine and lollipops for everybody, Ed. Ed loves that one. So between now and next week, as you're thinking about your future long-term goals, all the things you want to do with you and your money. Maybe it's retire. Maybe it's retire a little early. Maybe it's retire a little early and spend more money that you're spending while you're still working. Hey, we've got clients that have done it, and you can do it too. So don't just think about it. Think big. Think B-I-G. and we will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.